All right, welcome back. And you know the market's going to continue to gyrate. So yes, there is a part 3 to my discussion about markets gyrating and what to do. All right, so let's turn our attention to what is just a great concept. And I don't get credit for creating this. In fact, I'll give credit right up front. I ran across this article on LinkedIn. This is the business social media site. Dr. Daniel Crosby is an economist, behavioral finance psychologist guy, and he framed the question about the markets gyrating and how we respond to it beautifully. I love it. So I'm going to share it with you and I'll expand on it. So I'm going to share kind of the major theme with you, and then I'll give you my take on it. And the question or the focus is, when it comes to investing, what can you control and what can't you control? Now, I found a wonderful, great phrase from the Dalai Lama, number 14, and it's a great quote. I'll read it to you. If a problem is fixable, if a situation is such that you can do something about it, then there is no need to worry. If it's not fixable, then there's no help in worrying. There is no benefit in worrying whatsoever. Well, thank you, Dalai Lama. That, of course, could apply to all parts of our life. Sometimes difficult to apply and practice, right? I mean, that's the things that we worry and we roll around in our minds. If we could get to that, then maybe we can experience a state of nirvana. Very difficult, but it's something to bear in mind, especially with our investments. So let's talk about extracting from Dr. Crosby's framing of this question, the things we can control and the things we can't. And so we'll start with what we can't control. You ready for this? What is the biggest thing we all worry about when it comes to our investments? Returns. What are we going to make or not lose? Guess what we can't control? Returns. We cannot control unless you put your money into a fixed account, something that has a fixed rate of interest. Not many choices for that. A CD, a fixed annuity with a fixed rate of return. What else? Oh, that's it. I'm out. Bonds? Well, yeah, but the issuer has to be there, and if you happen to sell it before maturity, you'll get less than what you paid for it. So there's a devaluation risk, which ultimately means you're not getting the interest you think you got. So there are very few choices for a fixed return. So unless you choose one of those, there is no way to control return. Oh, well, David, you know, I had somebody tell me the other day that I can get a great secured investment, make a guarantee of 7%, blah, 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 blah. I'll guarantee you that if we dig down and look at that, whatever it is, the return is subject to fluctuation. It's based on whether or not the company can pay you. It might be some sort of high yield, high risk bond or senior secured debt or something else that's got variability. So unless you're going something very, very, very conservative and fixed in nature, like the CD or the fixed annuity, returns will vary. A lot of times I use the analogy of a boat with sails, a sailboat. And if we've got a great boat, wonderful big fat sails, it's just gorgeous, the best crew, everything is just wonderful. Calm seas, it's not going nowhere unless you've got some wind, and that's the market. The best portfolios, if they are based on the market, I got to have wind, so we can't control those returns. Now, with that said, what are the things that we can control? What are the things that are fixable or adjustable or that we can exercise control over? Therefore, we shouldn't worry about it. All right, here they are. Risk is one, cost, time, and emotion. Those are the big four that you can control. Risk. Risk is directly linked to how aggressive you are. The more money you put in the market, the more risk. The less risk. So we can have a direct control over that. Now, if we need money from our portfolio, we don't put it at risk. Cash. If we need $2,000 a month, that shouldn't be coming from the stock market, okay, unless you're able to get enough from dividends. It needs to be coming from something more secure. If you know you're going to need that money in a year, why in the world would you put that into the market or leave it in the market for that 1 year period? If you have cash, you're not going to go put it in the market for 1 year and say, all right, I'm going to throw it in the market, make some money and I'll need to take that 100 and go do something else with it because I've got a plan for that. That doesn't work. That's very risky. What else? Costs. Costs are a huge thing you can control. The average mutual fund, for example, costs 1.5% per year according to Lipper, okay? With some careful selection, maybe you hire somebody to help you do this, or you can do your research yourself. Careful selection, you can get that down to 0.5%, I would argue. 1% savings, $100,000 portfolio, 10 years, that's what? $10,000. You can control costs, and of course, requiring, expecting, demanding all costs, fees, compensation, all that stuff be disclosed to you in writing by anybody you're working with as an advisor. That'll help you also keep control on cost. All right, what else? Time. Time. You have control over how much time before you take money out of the market or out of any investment. Well, what do you mean? What if I need the money? What if I have an emergency? Well, that's what an emergency fund is for. Now, I generally recommend 5% or so of your investable assets be put in an emergency fund. So if you've got $500,000, I'm going to say, well, you know what? A $25,000 emergency fund probably is a good idea. Now, everybody's situation is a little different. That might increase that or decrease that. But the point is, if you have emergency funds, if you've got other things kind of organized, if you've got your insurances, if you've got these things in place, you should be in control of when you take money out of the market, not having to sell at an inopportune time to meet an unexpected situation. Now, there are, of course, going to always be potential extreme scenarios, but this is what planning's all about. What else can we control? The last but not least, emotions. Well, what do you mean, David? I mean, gosh, I'm human. If something happens, I'm going to be emotional. Yes, but this is why we build a financial plan. You put all these things together and you have a plan, a framework for your decision making. And you can say, okay, the market's down 10%. I'm thinking of getting out. Well, let's open up the plan. Let's take a look. Well, remember, you've only got 30% of your money in the market. You've got some cash emergency money. You've got money in a fixed account that's giving you income. You've got your long-term care. You've got your equity in your home as a backup. You see, and we've got income coming in. We're good. So is there a reason to panic and get all of our money out of the market when it's doing what it does about every other year, has a 10% correction? Why are we taking the money out of the market? There's not a good reason. Now, it doesn't mean you ignore what you have. Maybe there's something unusual about your portfolio. Maybe there's something about the investments. Maybe you've got poor performing funds. I had someone come to me not long ago and they had all their money was in precious metals and gold mining stocks and all these things, and they had been just lagging the market. So they didn't know, they didn't understand. So if you're not sure, get a double check. But I can tell you that in over 20 years of doing financial work, I've never seen a knee-jerk reaction to the market serve anybody well. Get a plan, and guess what? That'll help you plan stronger.